Okay, all right. So, hello everyone. Wishing you all a very pleasant morning. I hope you are doing well. And so, here's my first slide on the company name iCapital Academy and Corporate Advisory LLP. This is our disclaimer note. And well, my name is Moin Sheikh, and my internship title is Financial Modeling using Excel and AI, leading to equity research and valuation. So, now, my topic name is Smart Money Moves, Unveiling Bonds, Mutual Funds, and Valuation Strategies. So, let's dive deep into the world of bonds. This is my table of contents. Uh, in today's session, we will be covering the two main points, that is introduction to financial instruments, and we will also go through about bonds, its types, features, and valuation. So, now get ready, buckle up your seats, and let's dive deep into the world of bonds. Now, what is smart money? Can anyone tell me what is smart money? So my session will be an interactive session wherein you guys will also be answering some of the easy questions. So it will not get boring and all. Okay. So can anyone tell me what is smart money? Okay, no worries. I'll tell you. So smart money is nothing but investing our money investing our money into some useful into some useful things so that we can earn more returns. So here I have put an example. For instance, instead of buying stocks because they are hot, smart money invests in companies with strong fundamental and growth potential. Instead of we put our money into FDs, but there we get only max to max 6 to 7% return. But if we put our money in stocks, in bond, in mutual funds, we'll get a much higher return than as compared to banks. So this is nothing but we call a smart money. So now moving forward to next slide, it is why smart money management matters. So why does it matter? Why smart money management matters? Can anyone tell me why? What is the reason to to in today's world to manage our money smartly? Okay, so well, why does it matter? Because in today's world, we we are all affected by inflation. The inflation rate is rising and rising and rising. So if we invest our money into our banks, into a savings account, FD, RD, we'll get only max to max in saving account 3 to 4% of interest, in FD max to max 6 to 7% of interest, and in RD about 4 to 5% interest max. So instead of that, if we invest our money into the financial market and instruments such as stocks, bonds, or we can say uh, into some equity, mutual funds, etc., etc. So there we can double our money. We can get not double, but we can get more return as compared to the traditional banking system. So yeah, just I have taken the example over here. For example, putting money in a savings account with low interest may not keep up with inflation. So you all know that in today's scenario, the inflation has rose to around there is around it is more or less around 5%, and the inflation rate is around 5%. So if we invest our money into banks into savings account, there we are getting only 3 to 4% of interest annually, but our inflation is 5%. So you can see that we are already in 1 or 2% loss. We are losing the money. We are not gaining anything much. It seems like we are getting interest on savings account, but it is not. Instead, we are just losing our hard-earned money. We are just reducing the the price of our the value of our money. So in finance, we call one term as such as it is called time value of money. We will study it further. It is very important in today's aspect. So now let's come to our topic, fixed income securities. Now, what are these income securities? So let me tell you guys. The name itself suggests fixed income. That is when we are investing our money and at for a fixed period of time at the fixed interest rate. It is nothing but it is called fixed income securities. Okay, got it. So it is very simple. You just have to decode the term fixed income securities. The name itself says fixed means a fixed period of time and fixed interest rate we get on our investment. The money which we invest in the market, we get fixed interest rate as well as it is for a fixed duration or a fixed period of time. Okay. So these are typically a debt instrument issued by government, corporation, or financial institution to raise capital. Okay, if I have, suppose imagine I have a company, I want to raise funds, I want to raise capital. So what would I do? Yes, the very first thing which I would be doing is, I'll be issuing equity shares. I'll be offering the part ownership of my company to the investors. Second, what I can do is I can take debt. Debt from whom? From governments, from corporation, or from financial institution. Okay. Okay. All right. Madhu, Susan, can you please turn off your mic? Okay. So let's move further. So key features of fixed income securities. What are the key features? As I told you, fixed income means wherein our investment gets a fixed rate of interest. Okay. So number one thing, predictable returns. We can predict our return. For example, if I have invested into a fixed income security, suppose a bond, whose interest rate is 9%. So I can predict my returns. For example, I have put 1 lakh rupees into a particular bond at the rate of 9% per annum. Okay, so I can predict my returns. I will be getting around after 1 year around 1 lakh 9,000 rupees, right? So yes, we can predict our returns. Maturity date. So here we all know that the fixed income securities are of fixed tenure. So while issuing those securities, we already knew that our maturity date is supposed for say 3 years, 5 years, 7 years, or 10 years, or etc. So after that maturity date, we get our principal amount back. If I have invested 1 lakh rupees into a bond whose maturity date is 10 years, suppose. So after 10 years, I'm getting my 1 lakh rupees back. Okay, are you getting it? And the third is the most important key feature of a fixed income securities: lower risk. In today's market, we all know that equity and stock market are so much volatile that there is a high chances of risk. So instead of that, fixed income securities offers us a lower risk compared to equities, income, and etc. etc. Okay. The fourth point, interest rate sensitivity. You know, all price fluctuates inversely with interest rate. If RBI says that BPS rate is rising, then there is a slight change in the interest rate as well for bonds, for other fixed income securities. Okay. If the inflation rate rises, there is a there is a difference in the prices of fixed income securities, the interest rate in the for them. Okay. So these are the most important key features of um, fixed income securities. Guys, you take a note of what I am telling because it is very useful information and my presentation is very content rich. So yes, definitely you are going to learn a lot from this from the today's session, and it will help you in interview as well to to get the knowledge of your bonds, fixed income securities, mutual funds. It will help you a lot. So try to make some notes for it. Okay. So let's move further. Common types of fixed income securities. Now we have learned what are they. So these are the types of fixed income securities wherein we can invest our money into those. Okay. Number one, government bonds. Second, corporate bonds, municipal bonds, certificates of deposits, treasury bills, debentures, fixed deposit. So the above three are related to bonds: government bonds, corporate bonds, municipal bonds. In our India, RBI issues and regulate the bond. Okay, the bond market. RBI has the authority to regulate the bond market. Okay, for stock market, SEBI is considered as a regulatory body. Okay, so now corporate bond debentures. We all know debentures. It often unsecured debt instrument. It is a basically the debt to a company. A company issues its debentures for to raise its funds or to raise capital. So for that purpose, company issues debentures. All right. Now we all are aware about fixed deposit, aren't we? So yes. So we all know about fixed deposits. It's offered by a bank. And now coming to treasury bills, yeah, T bills. These are the very short-term fixed income security. It is issued mostly for less than a year. It is a very safest instrument, though it has though it don't have any risk. मतलब it has some, but it is considered as a very low riskier investment. Okay, treasury bill. And then now let's discuss more about these securities in detail in our next slides. Okay, but before that, we will come to types of investment vehicle. So, guys, do you know what is vehicle? We all know what is the use of vehicle. Vehicle helps us to travel from one point to another point. So the same way is investment vehicle. It travels, it takes our money from one point to another point. Okay. So what are those investment vehicles that can drive our money from point A to point B? There are various. For example, you can see stocks. You can invest your money in stocks and get a part ownership for in that particular company. Okay, you can also take bonds if you want a safer investment. You can consider bond as well because it offers a fixed interest rate to us, and it has a fixed maturity date. Okay, so third, mutual funds. Now mutual funds, what are these? Everyone knows mutual fund. Can anyone tell me the meaning of mutual fund? If you know. Okay, no worries. I'll tell you. Mutual fund is a company that pools money from various other retail investors, and put that money into a stock market, into financial market. And when they get the return, a part of the amount they give it to us as a return, and the remaining amount they take it for them as their income. Okay, so there is no any hard and fast any definition about mutual funds. It is very simple. Both ETFs, exchange traded funds. So these ETFs can be traded into stock market as well. Okay, and we all are aware about real estate as the investment made in the properties for example, we if we are buying a house, if you are buying specific uh, room for for some other purposes, like example for renting a shop or for stationary purposes or for a warehouse. So we are investing our money into properties, into real estate. So that also give us much higher return if invested properly and accurately. We also should have a good knowledge about real estate. We cannot we have to see certain parameters like whether it is Sitco approved, whether it has all the documents prepared and all, it is not illegal, and etc. etc. Okay, so do you guys have any query as far as we have done over here? If you want to ask any question, you are free. You feel free to ask me. Okay. No need to hesitate and all. Okay, so assuming that you all have understood, let's move forward. Urvi Mehta, can you please turn off your mic? Oh, good. So now let's start with basics of bonds. So from here, we will dive deep into the world of bonds. Now we all know what is bond. A bond is a loan you give to a government or a company. If I have a company and I want to issue funds, I want to raise capital, I want to raise funds. So what can I do? As I told you before, I can go by equity, I can go by debentures, or I can go by bonds. I'll issue bonds and I'll issue bonds to the people and I will pay them a specific fixed interest to them on their investment. Okay. The bond is nothing but a loan you give to a government or a company and that pays you interest. So in bond, there is an another substitute word for interest, which is called coupon. So coupon rate is also called as a interest rate. So whenever I tell you coupon rate, you just need to understand that coupon is nothing but interest rate. What interest we are getting is nothing but a coupon. Okay. So here I have considered one example. If you buy a 5-year government bond with a 6% coupon, so this coupon means interest rate. With a 6% interest rate, you get 6% of bonds face value each year. Okay. So I have invested say around 1 lakh into a 5-year government bond with a 6% interest rate. So on that 1 lakh, I will be getting 6% of interest every year. Okay. For that 1 lakh, I will be getting 6,000 every year into directly into my bank account. Okay. And at the end of the 5th year, when my bond comes to maturity, I'll get my 1 lakh rupees back. Okay. So basically, we have invested our money into bonds and we have gained the returns. And then after the maturity, we are getting our money back. Okay. So that's why bonds are considered as a safer financial instrument as compared to stock. Okay. But definitely it offers us lower return as compared to stock because stock market is much more volatile and it is much more risky. So with higher risk comes higher return. You have heard that quote, higher risk comes higher returns. Okay. So now let's move further. Basics of mutual funds. So as I have told you, what is mutual fund? Mutual fund. ये ज्योति बोली है, तो ये बता। Yeah, cool. Okay. So what are mutual funds? Mutual funds collect money from many investors, as I told you, and they invest into a diversified portfolio. They invest some of a part of your money into stocks, a part into bonds, or part into some other asset, for example, T-bills, FDs, and etc. etc. Okay. So this helps them to mitigate the risk, to mitigate the level of risk. Okay. Sorry. For example, I have taken an example. Instead of buying 10 different stocks yourself, you invest in a mutual fund that already holds a basket of stocks. So there are various types of mutual funds wherein they have a basket of stocks. They have a bunch of stocks into them. If we invest our money into that one mutual fund, our money will be diversified into the different stocks that they hold. Okay. So we don't need to, select one stock Reliance and put some amount, select one stock Tata Motors and put some amount, invest some amount into that company. So we don't have to do that, that struggle of investing, first of all researching about a company and then investing our hard-earned money into them. So instead of that, what we can do is we can take one mutual fund that is giving a good rate, good returns, and that is managed by a professional experienced person, so that we can make maximum return from it. Okay. We can directly put our all investment into that mutual fund and that mutual fund itself will diversify our portfolio. Okay. So now let's move further. Basics of valuation. So as I told you earlier that we will be studying bonds, mutual funds, and valuation. What are valuation? What is valuation? Valuation is nothing but we know determining the true worth of a particular asset. Okay, the true worth mean I would say in an intrinsic value, the value that an asset holds. Okay, so what is the right valuation of that? For example, bond. Let's say an example bond. What will be the right valuation of bond? Whether it is priced higher or where it is underpriced. Okay, so we'll get it. We will get to know about that in our next coming session. But for now, let's consider an example. If a company's stock price is 500, okay, if a company's stock price is trading at rupees 500, but as per your valuation, it shows that the stock is worth 700, but it is trading low. Okay, so it is underpriced. It is trading low. Stock has a capability to trade at 700, but it is trading at rupees 500. So that means that you have to invest in that stock because definitely it will generate you more returns. It will definitely hit the 700 mark. Okay. So same. So vice versa. Vice versa is for the it's the same thing. If the stock price is rupees 700, but your valuation shows that it is worth rupees 500, that means that that means that our stock is overpriced. So we should avoid those stocks. The valuation is very important in the in considering any financial instrument. We need to consider our value, our what is the value of a particular instrument, a particular stock, a particular bond. Okay, great. So let's move further. Risk versus return concept. The risk return trade-off means higher returns usually come with higher risk. Okay, so we all know that if we want to get higher returns, we should have a capacity, the appetite to take the higher risk. Okay, we should think in the mind that if you want the for example, I have invested 1 lakh and I want the highest return. I want a 1 lakh return. That has been 100% return in 1 year. Then I should be ready to to make a loss of rupees 1 lakh also. It is not like you want to just lose only 1,000 or 5,000 and you want to make 1 lakh. So it is not a right investment you are making. Okay, so if you want to get higher returns, you have to get the appetite for the higher risk, because there are some cases wherein if if we incurred more loss in our investment, then some person also might collapse and all, etc. Yeah, it has happened in some cases. So yes, so we'll take an example of, for example, investing in startup companies. Okay, so the companies which are just started, the startup companies, so that stock can offer you higher return because there is a more growth opportunity for that company. Okay, but at the same time, on the other hand, that company has a high chance of loss. You can lose all of your money if that startup didn't work, if that startup failed. What about your money? From where will they get you? Okay, there's a very high chance of making loss if you are invested 10 lakh rupees into a startup. So if that goes well, you will get much more, 100%, 200% returns over a period of time. But if that startup fails, so you forget your investment that you have put into it. Okay, so understanding your risk tolerance is the main aim of an investor. Every investor should have a clear mindset that yes, I can accept this much loss, I can accept this much risk. Okay, so you should have a clear mentality in your mind that yes, if I want to get returns, there will be loss. Everyone makes, there is no one who has made just a profit and profit and profit. Even I have made losses in the majority of cases. So that's not a big deal. Well, I'm if you guys will make loss now, you will get to learn more rather than making profit. The person who makes profit learns less as compared to the person who makes loss. So if you make loss, no matter, no need to worry, no need to get upset, and and to skip the trading investment and all. You are learning. It is a part of your learning. Okay, so there is a very well quote said that it is to keep your mind young. You should always learn. The At the point of time when you stop learning, your mind get old. Okay, so you should always keep learning and learning and learning, no matter whether you fall or whether you achieve something. Okay, so now let's come to the topic and moving to the next slide. Time value of money, the most important concept in finance. Okay, time value of money. So there is a quote said by uh, the great investor of all time, Warren Buffett. A rupee today is worth more than a rupee tomorrow. Okay, a rupee today is worth more than a rupee tomorrow. For example, if you have 100 rupees in your hand right now, okay, and if you have 100 rupees after 2 years, would that be same? Of course not, because the inflation rate is rising at, I said you, around, it is around approx 5% something, 4 to 5%, in between 4 to 5%. Okay, so it is nothing but you are losing the value of your money. Okay, so instead of keeping in bank, in saving account, in RD, in FD, you should be investing your money into some mutual fund, stocks, and bonds. But yes, you have to make a thorough research about that particular. Otherwise, you will lose your money. So, rather than losing your money, you should keep it in your hand. Okay. So, yeah, time value of money. For example, rupees 1000 invested today at 8% annual interest will grow to rupees 1080 in 1 year, as I told you. So, receiving rupees 1000 today is better than receiving rupees 1000 after 1 year. Okay. So if you receive 1000 today, you can invest into any of the securities and you will get the return. Okay. So as compared to receiving 1000 after 1 year. After 1 year, your amount will be better than 1000, definitely. Okay. Are you guys getting? Do you have any doubt? Then you can ask me. You can raise your hands or you can unmute yourself. Okay. So if you have any doubt, you can ask me. So for now, let's move further. Yes, key financial terms you should know. So these are the terms that is asked in the interview question as well. If you are a finance guy, if you want to make your career in finance, you should be dealing with the financial terms only. Okay. As I told you, if you talk about bonds, we talk interest rate. So rather than using interest rate, you should say coupon rate. It is a very good term, a good financial term that will tell the interviewer that yes, you have a knowledge, that yes, you have something, you have done some research, you have done, and you have well prepared. Okay, so the very first one is yield. What is yield? Yield is basically, if I talk about in layman terms, yield is nothing which an income which we get from our investment. Okay, the what I have invested, I am getting in return. So that return is called yield. Okay, so usually it can be interest, dividend, and basically it is expressed in the percentage. Okay, yield is basically expressed in the terms, in the percentage terms. Okay, so it is not expressed in the rupees or any other thing. Okay, so now come to NAV. NAV stands for net asset value. So net asset value, this NAV is used in mutual funds. We'll get to learn more about this NAV into mutual funds and how to value them, how to value the NAV. That yes, this is the right price we should buy. We will be discussing this in valuation session. Okay. So basically, the NAV is the price per unit of mutual fund. As I told you that there is a one unit of mutual fund, and in that there are many diversified, stocks. There are many stocks in it. So what is the price of that unit of mutual fund that NAV tells us? So don't worry, don't stress a lot. We will be studying this in our mutual fund chapter. Second, interest rate or coupon rate. So the cost of borrowing money or returns on bonds, the return which we get, or if I talk about a company point of view, the return which we give to our investor is called nothing but interest rate or coupon rate. Okay. The fourth one is dividend. We all know about dividend. The payment given to the shareholders, equity shareholders, different shareholders. The payment, the interest. We cannot say interest. We can say some of the profits are diluted to the equity shareholders and preference shareholders. If I have a company and I am generating a profit, let's say around 1,000, not 1,000, 100 crore. So from that 100 crore, I'll I'll pay some profits to my shareholders. So very first, I will be sharing my profit to the preference shareholder, and after sharing the profit to the preference shareholder, the part amount which is left, that amount I will be giving to the equity shareholders. So preference shareholders are given preference at the time of at the time of distributing dividends. Okay. So basically, dividend is nothing but a payment to shareholders from company profits. That's it. Now, what are capital gains? Capital gain is very easy. What we have invested, what we have in what we have invested in the assets, and the gain that we are generating from that asset is called capital gain. For example, if I have purchased a land of rupees 10 lakhs, and after a year or two, I am selling that land at rupees, you say, 12 lakhs. Okay. So whatever amount that I have gained is called as capital gain. The profit which I have got, which I have received. Okay. So here's an example. If you buy shares at rupees 100 and sells at rupees 150, your capital gain is rupees 50. So there is also a concept in tax where we calculate capital gain tax. The so as per my knowledge, there are two types of capital gain tax: short term and long term. One is short term, one is long term. We also call it as LTCG, long term capital gain tax, and short term capital gain tax. Okay. So short term is basically less than a year, and a long term is basically obviously about 1 year. Okay. So there is some tax structure into this, but we will not get into deep into tax because our topic is related to finance and bonds. So let's move further. Understanding market cycles. This is very important. We all know that there are two types of cycles. The one that is bull market, that means the cycle, that means the market when it goes upside, when it shows the upside movement, it is called bull market. What is upside movement? When the prices of stocks are rising continuously, it is called a bull market. And the same is for the opposite is for bear market, where the prices of stocks are falling continuously and it is in the downward direction. It is called a bear market. For example, the stock market rose steadily from 2016 to 2020. So this is what it is called the bull market, but crashed during the COVID-19. So we all know, we have experienced the pandemic, and we all know that the the stock market that fell was the worst in one of the worst in the history of the stock market. Okay. So yes, these are the some basics and easy term that everyone should know. Okay. So moving forward, importance of diversification. Yes, diversification is very much important. I'll give you a one example. Okay, if you have a basket and in that basket you have 12 eggs. If you have just one basket and in that basket you have 12 eggs, if that basket falls, then all of your 12 eggs are broken. Okay. So what we can do is to avoid loss, we will diversify our basket. We will diversify our eggs. For example, I have 12 eggs. I will put two in one basket, two in another, two in another. So that means I have six baskets. Even if one falls, there are five baskets, which that means my 10 eggs are safe. Okay. Rather than, rather than wasting or losing all of my 12 eggs, my only two eggs are gone, and the remaining five baskets are there of total of 10 eggs. So from that, I can recover my loss. Okay. So this is a very common example that is given in the field of finance for the term diversification. So as you can see over here, diversification means spreading investment across different asset types. Okay. If I have capital of rupees 1 lakh, then I will invest 10,000 in Reliance, 10,000 in IRFC, 10,000 in Tata Motors. Why? To avoid loss. If I invest 1 lakh rupees into Adani Ports, and if it falls, I will be either losing my all the money, all the 1 lakh. But instead, if I diversify my portfolio, it will help me to avoid, large, huge losses. And even one stock can give me a maximum profit that as compared to other stocks. So diversification is very important in at the time of investing. Okay. So let's consider an example. If you invest only in tech stocks and that sector crashes, you lose a lot. Okay. Because you have invested your all of your money, all of your hard-earned money into a one particular stock. And if that sector crashes or if that company fails, so you are losing all of your money. But but if you hold, if you buy stocks, bonds, and real estate, the risk is usually lower. Common sense. Okay. All right. So let's move further. Part one, bonds. Just a minute, guys. Okay, so now from here, our main topic starts. That is bonds. The topic which we have covered is very much useful, is very much important for a finance people to understand the terms and to get a proper knowledge. It will help us in our interview purpose. So before going ahead with the bonds, do you guys have any question or have any query? You can ask me. You can unmute yourself and you can ask me. Feel free to ask me. If there is any such concept you have not understood, so you can ask me. Okay, I'm assuming that there is no question as such. And okay, so let's move forward and dive deep into the world of bonds. Bonds, as I have explained you before, bonds are the fixed income instrument where you lend your money to a company, to any government, to any financial institution, and then you earn interest at a fixed period of time for a fixed year of maturity. Okay. For example, when you buy a government bond, you are lending money to the government, and that government is promising that it will pay your money back with interest. Okay. So we all know about bonds. So let's move further. Types of bonds. Yes, this is very important. Types of bonds. So there are various types of bond. So out of which I have listed some of them. They are government bonds, corporate bonds, municipal bonds, zero coupon bond, are also called as deep discount bond. This bond is gaining very much popularity in today's market. Zero coupon bond, or also we can say deep discount bond. This bond has is gaining popularity in today's market. Then next one is plain vanilla bond or conventional bond, non-conventional bond, perpetual bond, and the new emerging bond, green bonds. Okay, so we will be studying brief about them into our further slides. Government bonds. So the name itself suggests government bonds, the bonds that are issued by governments or government of India. As I told you, that RBI regulates the bond market. So basically, it is issued by RBI. Obviously, government means RBI. So it is issued by RBI. So there are various government bonds, for example, GSEC bond, treasury bills, CDs. Okay. So the quality of this bond, the feature of this bond is it offers us low risk. Okay, if you don't want, if you are investor and we don't want to take much risk, so we can invest in bonds. It is a safer instrument to keep our money safe and also to earn interest that is much more than the bank, bank interest rates. Okay, so why does a government issue bonds? Do you know why does a government issue bond? Because they want to raise money, because they want to raise capital for their projects, for building, for building infrastructure, for building dams, metros, railways, etc., etc. So they need some funds. So that's the reason they issue the bonds. Okay. For example, it is there 10 years, 10-year GSEC sovereign gold bonds. What is sovereign gold bonds? So sovereign gold bond is nothing but we can invest our money into virtual gold. We can buy gold virtually, you know, rather than going to a shop and then buying a jewelry. They take additional charges and all GST and all. So we have to pay additional GST charges, etc. So instead of that, what we can do is we can invest into gold, but virtually. Okay. So yes, it is one of the concepts sovereign gold bonds. You can research about this concept. It's very much important, and it will be very much helpful for you guys. So please look at it on sovereign gold bonds. We'll move further. Corporate bonds. So as I told you, if you are a finance guy, you need to break some complex term into simple words. If you're not understanding what does it this mean, just break the words into some smaller parts. For example, what will I consider to this corporate bond? Corporate, when issued by the organization, issued by the company, the bond that is issued by the company to raise capital, to raise fund, is called corporate bond. It's as simple as that. Okay. So here we can consider higher risk, but yes, higher yield also. What is yield? Income from an investment. As we have explained it, I have explained before. What is yield? Yield means what we are getting back over our investment. Okay, this is nothing but yield. Now let's come to credit rating. Credit rating. Oh, it is very important. We will study this in our further slides. And okay, so yes, this is all about corporate bonds. Now moving to the municipal bonds. Same as I told you, issued by city councils or municipal corporation for for building, for constructing roads, and for some other projects. Because because they need money, they need capital, they need funds to construct the roads, bridges, dams, etc. So for that purpose, the municipal corporation issues those bonds. It also has a very good tax benefit. If you want to save tax, you can issue bonds as well. You can issue municipal bonds as well. Okay, so it is a growing trend in India. Why it is growing? Because it is helping us to save taxes. So that's the reason it is growing. And okay, so let's move further. Zero coupon bonds. Okay, so this is one of the most important and most popular bond. It's gaining much more popularity in today's market. Zero coupon bond, are also known as deep discount bond. Am I audible?
Yes,
Okay, good. So zero coupon bonds. What do we mean by coupon? Is an interest rate. Zero interest rate bond. A bond wherein we cannot expect any interest. Okay. There is no any periodic interest payments. There is no interest. So these bond are, why it is called deep discount bond, because of they don't have any interest rate. They are deeply discounted from their face value. Okay. For example, a bond has a face value of rupees 1,000. So we will discount it. What do we mean discount? We will lower the price of that bond. For example, if there is a bond of rupees 1000 face value, we will discount deep and we will get it in rupees 900 to rupees 800. Okay, we will discount that bond because we cannot expect any interest payment. So that's the reason. Now, how to value such bonds? How we can value, yes, that this is worth investing. If we will invest this, we will get a good return. How we will value this? So, my dear friends, and teachers, we will be studying this in our upcoming session, that is evaluation. How to value these bonds? How to value these bonds? How to get their intrinsic value? How to know that yes, this bond is worth investing? So we will study deep into our valuation session. So you guys be there in that session as well. It will be very informative and fruitful for you. Now coming to callable and convertible bonds. Callable bonds. Issuer can redeem early. For example, if I am issuing a bonds, so I am a issuer, correct? I am issuing a bonds. So I have issued a bond and it is of it does not have any fixed period. I can call it anytime. For example, after 3 years, after 4 years, after 5 years, when I feel that yes, I have to call my bonds, I can directly call to that issuee and tell him that yes, you can take your bond back and you can redeem early. Okay, so it is called callable bonds. Second one is convertible bonds. The bonds that is converted into equity. The bond that can be converted into equity is called convertible bonds. It is very popular and it is very much very much fruitful for us to go with this bond because after that we can also get an equity into a company. We can also be a part of a company. We can get a part of ownership. So yes, this is very important and this is very much popular bonds, that is convertible bonds. It is hybrid in nature. Yes, the very good quality of feature is it is hybrid in nature. We have the debt plus potential equity upside. We can convert our debt into the equity. Okay, we can get equity in as compared to debt. So let's move further. And green bonds. As I told you, that green bonds are taking a huge jump into today's market because we all know that there are various schemes to protect and save our environment. So for example, for saving water conservation, uh, go green some schemes, and many more, etc. Save water, save electricity. So for this particular project, government needs funds. Government needs some capital, so they issue green bonds. So green bonds are issued to raise funds for environmentally sustainable projects. So yes, Sunil Kumar, can you please turn off your mic? Cool. Okay. So where was I? Yeah, green bonds. So green bonds usually helps the government to raise funds for environmentally sustainable projects. There are some projects that from, as I told you, renewable energy, pollution reduction, climate change mitigation, clean transportation. So these are the projects that government require funds and they want to raise funds. So how can do they? So they are issuing green bonds. Okay, it is very simple. It is very easy. Yes, there are some bond terminology that we have to consider and we have to keep it in mind because this will help us, to be a good finance students. If we are going into an interview and we don't know some financial key terms, keywords, or some bond terminology, that means we are not professional or expert into the field of finance. Okay, so for that you need to consider some terminologies, some financial keywords, key terms. So Let's come to bond terminology. The very first term is face value. What is a face value? It is very simple. Face value is nothing but original value of bond, the price, the value of a bond. Face value is also called as par value. If you heard some word into the question that the bond is issued at par, that means that that bond is issued at face value. Par value is also known as face value. Okay, keep this in mind. Make a note of it because it is very important. Okay, coming to coupon rate, we all know coupon rate is nothing but interest rate. Maturity, the date at which the bond is going to mature, the date at which we are going to get our principal amount back is called maturity. Yield, we all know, return that we are getting on our investment. Okay, issuer, it is an entity, the company, the government who is issuing the bond is called as an issuer. Okay, the company, the person, or no, not the person, the company or the entity who issues the bond is called as an issuer. Okay, all right, let's move further. Bond features. Okay, face value. So amount that you will get after your maturity is your face value. Okay, if you have purchased a bond at rupees 1000 and after maturity you are getting it at par, that means you are getting it at face value. So this is nothing but face value. Coupon rate we all are familiar. Maturity we have seen. And so come to an example. Rupees 1000 bond with 7% coupon for 5 years pays rupees 70 each year. Okay. So here the interest rate is 7%, we all know. So every year we will get 70 rupees on 1000, 7% 70. All right. And after that 5 years, we will get our 1000 rupees back. The 1000 which is our principal amount we will get back. Additionally we will get 5 year interest, 70, 70, 70, 70, which is nothing but 350 rupees interest we are getting in 5 years. So this is just an example. So don't think that we can invest 1000 in bond. The ideal investment, if you want to invest in bond, is more than a lakh. Yeah, you need to have more than 1 lakh, above 1 lakh. As far as my knowledge is concerned, above you need to have about above 1 lakh. You cannot invest rupees 1000 into bond. Okay. Next slide. How bonds work. So how do bonds work? I'll tell you. Suppose I have a company and I am issuing a bond. I am raising funds, correct? I am raising fund. I am issuing bonds. So if I am raising fund, I am getting the money, and that money I am investing in other assets, or that money I am investing in my company. Okay, so the return which I am making, which, as a company owner, which I am making a return, the part amount is given to the bond holder, the person who has taken my bond. I'll get a part of amount as an interest to them. So this is how bonds work, and I need to pay them a regular fixed interest every year till the maturity of a bond. And if that bond matures, I have to pay the principal amount to them that they have paid me initially. For example, they have paid me 10 lakhs rupees initially. After 5 years, I have to pay back their 10 lakh rupees to them. I cannot say that now take 5 lakh, or take, you can take 10 lakh, you can take 8 lakhs. I have to return the full amount, the full principal amount that they have given me initially. Okay, so you can consider an example over here. If you hold a 10-year bond, you receive interest every year. That we all have understood that we will be receiving interest every year. Okay, till the 10th year. Every year we will be receiving the interest, only the interest. And after, when our bond matures at 10th year, we will get the principal amount back. Okay, good. Now let's move further. Bond pricing. Now I have told you how we will be valuing a bond. So yes, definitely we will be learning in our session. But let's consider this. Bond prices fluctuates based on interest rate and credit risk. Okay. If if the bank, if the RBI raises interest rate, if the interest rate rise, the value, the face value of bond will go down. Okay. As the interest rate rises, the value of bond decreases. You have to keep this in mind. Interest rate rise, bond price decrease. Okay. Now, why is this so? Okay, so let's say an example. If I have a bond of rupees 1000 and it has an interest rate of rupees 8% per annum. Okay, but now the RBI has raised the interest rate to from 8% to 10%. So there are new bonds. So if I am getting same same bond of rupees 1000 and I am getting interest 10%, so definitely I will be choosing that new bond. Why would I choose a bond that will pay me an 8% interest if I have an option of getting 10% annually? Okay. So that's the reason if the interest rate rises, the price of the value, the price of the bond falls. Because on one hand, I have 1000 rupees bond, 8% at a rate, 8% interest rate. And on the other hand, I have a bond of rupees 1000 at 10% interest rate. I'm getting 2% extra. So definitely the price, the demand of this older bond will decrease. Okay. So this is not nothing but a bond pricing. If market rate rises, existing bond prices falls because new bonds offer higher coupon rate, that is higher interest rate. So for your reference or for your better understanding, we can take an example. If you hold a bond with 6% coupon, but new bond pays 8%, so definitely you will go with new bond. So your bond is less attractive that older bond. Okay, so that's the reason the price of that bond drops. This is nothing but a bond pricing, basics of bond pricing. Now coming to the difference between yield versus coupon rate. We all know coupon rate is nothing but an interest rate. What is yield? Yield, what I will yield after the end of 5 years, what I will get in return. The actual return an investor gets is called as yield. Okay, but it can depend on bond price fluctuation. Huh? Because if when I, as I told you, if RBI raises the price interest, if they raises interest rate, the bond price will decrease. So definitely my yield will be less. Okay, so let's see an example over here. If a bond's coupon rate is 6% on rupees 1000 face value, it pays rupees 60 annually. Okay, but if you buy it at rupees 900, if you discount the bond, if you discount the bond from rupees 1000 to rupees 900 and you buy it in rupees 900, your yield is higher definitely because every year you are getting 60 rupees on the face value of rupees 900. So basically the yield is more or less 6.67 percentage. Okay, so this is nothing but a yield. It depends on on the bond prices, the fluctuation in it. Now coming to our next slide, bond yield types. Okay, so there are various yield types. The first one is current yield, yield to maturity, which is also known as YTM, and realized YTM. So we have a formula for all this. We will be studying it in our next slides as well, and also we will be studying in our valuation strategies. What is the formula for YTM, current yield, and etc. etc. Okay, so I'll tell you in short what are those terms. Current yield. So annual interest rate divided by current market price is what we get current yield. We will get it in percentage form. Okay. So matlab, the annual coupon. annual interest rate that a bond is giving divided by current market price of a bond. So dividing that, we will get our current yield. Yield to maturity, we all know yield, a return to an investor at the time of maturity. Okay, the total return that an investor can expect.
हाँ तो
Okay,
अभी तो
when a bond matures. And the third one is realized YTM. Realized YTM refers to the actual return. Okay, so it is an actual return an investor receive, including the principal amount and including the interest. Okay, that they are getting. So basically, yield to maturity is a return that a bondholder gets on the interest return, and realized YTM is the interest return plus the principal amount that a bondholder gets. So as we have seen types of yield, so calculation of yield to maturity. Now you can note down this formula for calculating the YTM of a regular bond, of a zero coupon bond, of a plain vanilla bond. Okay, so these are the formula for those. So you can take a note of it. I plus F minus P upon N upon F plus P upon 2 into 100. This is a formula for calculating the YTM, where I stands for interest rate, F stands for face value, and P stands for premium. Upon N. What is that N? That N stands for number of years, the maturity, the how much year the bond is, the duration of a bond. Okay. So YTM of perpetual bond. How to calculate the YTM of perpetual bond? There's a formula I upon P into 100. It's as simple as that. Just I upon P into 100. It's not much difficult about. And yes, so now, how to make the decision? If we are calculating YTM of a bond, how can we consider? How can we make decision? How can we should get to know that yes, we can invest in this bond, or we should avoid these bonds. So these are the decision criteria. Should take a screenshot of it. I would say if YTM is more than required rate of return, then bonds should be purchased. Okay. If if the required rate of return is less, if I am expecting 6% return at the every per annum. Okay, if I am expecting 6% return, but my YTM is telling that the YTM is 7%. So that means that the bond should be purchased because it has a good potential. It has a good interest rate. As per my expectation, it is giving me more. So I will invest in that bond. Okay. Second one, obviously vice versa, is YTM is less than required rate of return, then a bond should not be purchased. Okay. So there is only one case in which we should not consider, we should not purchase a bond. What is it? It is nothing but if a YTM is less, then we should avoid those bonds. What if YTM is equal to or greater than the required rate of interest? Obviously, we should purchase that bond, whether it is equal to or whether it is more than. Okay, so we should consider or purchase that bond. Moving further, and yes, so we have bond ratings and their importance. If you guys want to learn more about bonds, then how it works, what are those rating? There's a one movie named The Big Short. It is an English movie. You can see it is based on the bond market. It is based on the 2008 financial crisis that occurred in US. So I would suggest you to watch that movie, which is named The Big Short. Okay. So now coming to the bond rating, there are different ratings given to bonds: triple A, double A, triple B, etc., etc. D. D means default. Okay. So what does this bond rating do? It measures the credit worthiness of the issuer. That yes, that we have a low risk of default. It tells if a bond is rated AAA, we can consider it as a safe investment because definitely we will get our money back. We will not lose our money. So these are the ratings. You know, the concept of CIBIL score. Our bank consider our CIBIL score to give us the loan. Why would they do that? Because if you have a good CIBIL score, so bank will think like yes, you can repay our money back. So they will give you the loan easily. And yes, the same is for the bonds. If the bond is rated as a AAA, it is considered as a safe. That we know that we will be getting our money back. Anyhow, we will be getting our money back because the bond is very much secured, very much safe. Okay, so these are the ratings. So always when you guys will purchase a bond, you just consider the ratings. Government bonds, as I told you, they are the most safest bond. So they usually have a AAA rating. While some corporate bonds maybe have some rating of B, triple B or lower. Okay, so you should consider the ratings to invest in that bonds. And next slide, bond rating. So how we will get to know that yes, this bond is good? How we will consider that yes, this bond should be given a triple A rating or a double B rating? So this basically the ratings are given by the agencies like sorry, like CRISIL, ICRA, ICRA, SNP. These are the companies, agencies that that use the ratings that consider the bonds and then use the ratings. So with the help of those ratings, we can go with our decision. Triple A is highest quality bond with lowest risk, and D is equal to default. Default means that we have lost all our money. Default bond which has a highest risk, and we can lose all of our money at any point of our time. Okay, so there is one suggestion, or we can say I can say that we should avoid junk bonds. Okay, to unless you are aware of the risk. Okay, if you're not aware of any risk, that how much risk a bond holds, so you can avoid such junk bonds because our our money is our hard earned money. The investment which we are making is our hard earned investment, and we don't want to lose that. Okay, so we should avoid junk bonds because it is very risky. Yes, if you are willing to take risk in, and if you don't care about your money, then you can go ahead with the junk bonds, no problem, no worries. Or else if you want to save your money, if you generally feel like yes, my money is very much hard earned, so you should avoid junk bonds and be safe, be a safe investor. Okay, investment grade versus junk bonds. What is investment grade? It is a high credit quality bonds with lower risk. So generally it is rated triple B and above. What is above? Above is triple A. Okay. So these are the good quality bonds with a lower risk. And if I talk about junk bond, as I told you before, the bond which has a very higher risk is called junk bond. Definitely, I told you that higher risk comes higher returns. If you are willing to take higher risks, then you can expect a good return. So yes, junk bond is riskier, but yet it often yield us higher returns. So basically, it is rated below triple B, that is double B, or sometimes D as well. So you can see an example over here. A startup issuing bonds with poor financials might offer junk bonds to attract investors by promising higher interest but a higher risk of default. As a company is a startup, they can offer you a good return over a period of time. But yes, it has a very highest risk because that company can dissolve at any point of time. We don't know when. Okay, so moving on further slides. Factors affecting bond prices. So what are the key factors that affect bond price? As I had told you, changes in interest rate. If RBI fluctuates the interest rate, it affects our bond prices. Okay. Credit rating changes. The rating that is given, okay, the rating that is given, if it changes, it affects the bond prices. Simple. Okay. And then the coming to the most basic and most obvious reason, inflation expectation. Inflation also, drives the prices of our bonds. If the inflation rates decline, the price of bonds, increase because we can expect much more return, and vice versa. Obviously, supply and demand. If there's a demand of that bond, if there is more demand of a bond, there is a less supply because you know what? Because that will increase the price of a bond. That will usually increase the price of a bond. If there's high demand, the usually the price for a bond is usually higher. Okay, and vice versa, low demand, low price of a bond. So if the central bank, which is our RBI, the Central Bank of India is the only one, that is RBI, Reserve Bank of India. If that RBI raises interest rates, bond prices falls. Okay, as new bonds pay higher coupon, making existing bond less attractive. We have discussed it earlier also, so you can relate it with and you can understand it better. Okay, the reason which why I have repeated this some two to three lines is because you can understand it much more better way. You can understand and you can fix into your mind. Yes, this is what a bond prices works. Okay, interest rate risk, as we have discussed, that if the bond prices falls, the interest rate rises. And the very much important concept is, you know, a bond which has a longer maturity, a longer duration, a longer maturity is more sensitive towards the interest rate. Because if I have bond that is that will mature after 10 years, so I don't know that obviously that in between that 10 years, the interest rate will rise, obviously. So the value of my bond will anyhow will decrease. So the bond which are of higher duration, which are of higher maturity now, they are they are more sensitive to the risk of loss, to the risk of changes in the interest rate. So you can lose your money as well. I can say that. How you can lose your money? Because you will get less return from your face value. If your face value will decline, you will get a less returns over them. Okay. So here's an example. A 10-year bond will lose more value than a 2-year bond if rate rise due to longer exposure. Okay. So as we all know that a 10-year bond in between, definitely there will be interest change. So the 2-year bond will be much more, it will be less riskier and it will have a less exposure to interest rates. So yes, this is all about it. Okay. All right. Now moving further, let me tell you, let me move to a further slides. Credit risk. Now, what are this? What is credit risk? The risk that the bond issuer will fail to make interest or principal payments. Okay. The risk of that if our bond is at risk, that whether we will get interest or whether we will get a principal amount back or not, it is called a credit risk. If a company faces financial trouble, it might default on bond payments, causing investor to lose money. Okay, so it is quite obvious that if I have a company and I am facing some financial issues, some financial troubles, then how can I be able to pay back the interest or the principal amount of a bond? So yes, it has some uh, risk. So that will cause my investor to lose money in the market from that bond, because I'm not able to pay them the interest rate, neither their principal amount. So they will lose anyhow. They will lose their money. Okay. Inflation risk. So inflation reduces the real value of bond interest payment and principal payment. For example, here it is written, if inflation is 5%, but your bond pays 4%, you are not gaining anything. You are just losing your money, because every year the inflation rate is 5% and you are getting only 4%. That means you are making 1% loss. So you should consider a bond that is offering you a higher rate of return, higher coupon rate as compared to inflation rate. Because why we are investing? What is the primary focus of us to investing in that bond, into the financial instrument, to, to, to generate more returns as compared to bank and to beat the inflation rate. So that's the reason we are investing, correct? So you should consider a bond that is, offering us a higher return as compared to inflation rate. All right. So let's move further. It is bond duration and convexity. So duration is what I have told you earlier. Okay. Duration is nothing but how much the maturity, basically the maturity. It is a measures bond price sensitivity to interest rate changes. Okay. So as we all know, the price is very much sensitive to interest rate. So it measures the sensitivity of our bond price. Okay. So this is nothing but a duration. We have a formula for it, duration, which is also known as Macaulay duration. Macaulay, Macaulay duration. We will be studying this in valuation session as well. But I'm just giving you a shorter understanding of what is it. What is it? So duration, also known as Macaulay duration, we have a formula for that, and we will be studying it later. Okay. Now coming to the convexity. Yes. So convexity of a bond. So what is convexity? It measures how duration changes as rate changes. And also it gives us the estimates of our refined price, of a new price, that the what our price is going to change. It gives us an estimate, yeah, that yes, this is the point at which our price is going to change. This is the estimates of the price. Okay, are you getting me? So as far as now we have raised, do you guys have any questions? You are feel free to ask me. Any question you have, any concept you have not understood, you can ask me. You can raise your hand, or you can chat in chat box, or you can unmute yourself and you can tell me. So is there any question you guys have? No question as of such. Okay, no worries. Okay, yeah, no worry. We'll move further. Wait a minute. Your answer clear. Okay, all right. Let's move further. How to calculate bond price? How to calculate a bond price? I have taken a simple example just for your basic understanding. We will be dealing with it in our valuation session. So as we all know, bond price is nothing but a present value of a future coupon payments. Okay, bond price is equal to present value of future coupon payments plus present value of principal repayment. Okay, this looks a bit complex. I'll tell you in a more simplified way. Bond price. Okay. The what is the bond price? The return which we are getting, the coupon rate, the return which we are getting every year, plus the principal amount that we are going to get back is called a bond price. You have to plus the interest rate annually, the interest rate which you have written, which you have got in the given period of time, plus your principal amount. The amount that you have invested is nothing but a bond price. Okay, so here we have calculate price of rupees 1000 bond paying rupees 50 yearly coupons. Okay, so here we have not given the coupon rate. We have directly given the interest rate, the coupon amount. Okay, we have not given the coupon rate. We have given the coupon amount that every year we will be making 50 rupees on a price of rupees 1000. Every year we will be getting 50 rupees. Okay, until it gets mature up to 5 years. Okay, and 6% market interest. Discount each payment to present and sum. Okay, so this is a sum. This is a very basic sum. Even you can do it by yourself, and if not, okay, no worries. I will be telling you in the upcoming session of valuation. Okay, so for now, we can move forward, and it's already up 90 minutes. So guys, let's have a break of 5 minutes to get your water, or you know, let's take a break of refreshing break of 5 minutes. We will be back at 11:45. Okay, thank you. Okay, everyone, we are back with the break. Okay, so just a small, quick revision on some essential financial terms. We all know about duration. What is duration? It measures the bond sensitivity to interest rate changes. It measures the bond sensitivity to interest rate changes. Okay, this is nothing but the duration. We all know about it. And what next? We all know about credit risk as well. Okay, so let me ask you one thing. Do you guys know about sinking fund? What is sinking fund? Okay, sinking fund is nothing but a fund to retire bond early. If I want to retire my bond early, I will be taking the help of sinking fund. Okay, so it is very easy. Sinking fund is nothing but a fund used to retire bonds early before their maturity. Okay, all right. So now let's move forward. Wait a minute. Where we are, tax considerations. Okay, all right. Let me resume. Okay, types of bond issuance. So, an entity or a government or a financial institution can issue their bonds via public issue or via private placement. So, we all know what is public issue. A bonds directly sold to a general public, general retailer like you and me. Okay, via stock exchanges. So, it is called a public issue. Now, what is private placement? So this is nothing, the name itself says private. That is a bond is sold privately to a small group of investors. So a company or an entity does not tell everyone that we are issuing bonds, we are issuing bonds. They just simply secretly they sold issue their bonds to a small group of investors. Okay. So for example, a company might issue bonds privately to institutional investors to raise large capital quickly. If they want quick uh, capital, then they can issue a they can do it via private placement. All right. Now tax consideration on bonds. Interest from bonds may be taxable or tax exempt. Look, notice the word which we are using. Interest from bonds. The interest which we are getting from bond can be taxable or can be tax exempt, depending on the bond type and country law. So we have discussed the municipal bond. So those are the bonds which wherein we are not liable to pay any tax. They are tax-free bond. Any interest which we are getting from municipal bond is tax exempt. So yes, it is very good source of income, and also to to don't to avoid paying taxes. All right. So yes, here is an example. Municipal bonds in some countries offer tax-free interest income, attractive for high-income investors. So in India also we have some municipal bonds that are tax-free, or we can say tax exempt. Okay. Coming to the next slide, role of bonds in portfolio. Okay, as we all know, bonds provides us the income, most stable income, balancing. So it also helps us to balance riskier assets. If I have a capital of rupees 1 lakh and I have invested that 60,000 into a riskier asset called stock, so I want to balance my portfolio. I don't want to suffer loss. So remaining 40,000, I will be investing in bond because there I can get a fixed return of interest. Okay, so that interest rate will help me to 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 balance my loss if I get any. Okay, so usually majority of people what they do is they use a 60-40 portfolio. comprising of 60% stocks and 40% of bonds to reduce volatility and to reduce the risk of in our investment. Okay, all right. Coming to the advantages of investing in bonds. Now we all know that what are bonds, how are they value, how are their price sensitivity, their duration, Macaulay duration. So now what is the advantage of investing in bonds? Why should I invest in it? Because the number one reason, regular income through coupon. Coupon means interest. So we get an annual regular rate of interest, okay, into our bank account. Lower risk than stocks, okay. It offers a lower risk as compared to stocks or other financial instruments. Capital preservation at maturity. Okay, so what does this mean? If initially I have purchased a bond of rupees 2 lakh at the maturity, I'll get my 2 lakh rupees back. So this is nothing but a capital preservation at maturity. Diversification benefits. Okay, so we can diversify our portfolio using bonds. So retired investors prefer bonds for reliable income and low risk because at that stage when we are retired we are anywhere between 50 and 60, okay. So if you are retiring at that age we are not capable of of taking more loss. Our loss or risk appetite is very much low, so that's the reason that most of the retired people invest or prefer bonds for reliable, stable and steady income. All right, now every coin has two faces, has two sides. So same it is there for bonds as well. There is advantages and there is disadvantages as well. So what are they? We have already discussed it in our previous slides. Interest rate risk. As RBI rise interest, the bond price falls. Okay. Inflation risk. If the inflation raise, if the inflation rate rises, bond prices falls. Credit risk. Okay. So credit risk is nothing but as we have discussed it in earlier slides that the of risk of a bond that basically the risk that a bond has is known as a credit risk. Okay, lower returns compared to stocks. Definitely, it has a it gives us a lower return, but it is the most safer instrument. It is one of the most safest instrument. For example, if rates rise sharply, bondholder may suffer capital losses if they sell before maturity. Okay, we never know that the rate will become normal or it will decrease. We never know. So if we sell our bonds before maturity, we will suffer the losses. Okay, so next slide. How to buy bonds. Now, everyone might be having a question in your mind that how we should buy bonds. So you can buy bonds via brokers, online platforms, exchanges, or government or directly from the RBI. You can also buy a bond from RBI auctions and through NSE platforms, National Stock Exchange platform as well. Okay. So most of you might be having your demat account and your your broker who might be having access to dealing with the bonds aspect. So you can check with them also. Now understanding sovereign bonds. We have discussed about sovereign gold bonds. That is nothing but buying gold virtually. So sovereign bonds are government issued. Obviously, they are government issued and considered as the instrument, safest investment. Why? Because even if government is facing losses, government has government that is RBI has a capacity, has a capability to print money or raise taxes. So if they are running in losses, so they will print more money to beat inflation, or they will they will raise the taxes. So the inflow of money will be higher to them, and then they can give us the return, the interest return. Okay, then they can give us the interest payment. Okay, all right. Example, US Treasury bonds are a global safe haven investment. So in US, Treasury bonds are considered as a safest, safe haven for investment. This is a normal general knowledge current affair. So you can keep this in mind. Corporate bonds, features and its examples. So we all know about corporate bonds issued by companies to raise funds for expansion of their project. They usually offer higher yields. Yield is what? Return from an investment. So they usually offer higher returns than government bond, but they have a highest risk. Okay. Example, Reliance Industries issues corporate bonds with 7.5% coupon rate for 10 years. Okay. So the return is usually higher as compared to saving account, RD, FD, and it is generally higher than the inflation rate. So yes, it definitely it will benefit us in the long term. We'll get more return. We will beat the inflation rate. So moving further, zero coupon bond. So these are the bonds that are that are sold at a discount rate. Why discount? Because there is no interest rate. The investor is not getting any return. So that's the reason they are discounted at a very low price and but redeemed. And yes, they are discounted at a low price. But at the time of maturity, they are redeemed at their face value, at their par value. Okay. For example, if there is a rupees 1000 face value zero coupon bond, so definitely it is not paying me any interest, so I'll discount him. So rather than paying rupees 1000, I'll discount it and I'll pay rupees 800. Okay, but I am paying rupees 800, but at the time of maturity I am getting rupees 1000. Okay, are you getting my point? So look, here's an example. Buy at rupees 800, receive 1000 after 5 years. So this is nothing but a return from capital gain. So next slide is inflation index bonds. So as we all know that we are investing our money to beat inflation to generate some income, some profits, to expand our money, to generate more income. So these are the bonds where principal and our interest payments are adjusted with the inflation rate. Okay. So if the inflation rate rises, the price, the coupon rate of a bond also rises. Okay. So in order to beat the inflation, that's why it is known as the inflation index bonds. Treasury inflation protected securities, and in the US, so these are the securities, these are the bond which is a inflation index bond, which adjusts based on the inflation rate. Okay, moving forward, bond funds versus individual bond. What are bond funds? It is a bond in which there are multiple. It is uh,
Exploratory thing. Trend line and scenario forecasting to linear
sorry, what?
forecasting sheet.
Can you repeat your question, Mr. Rohan? I didn't get you. Do you have any question? Okay, so let's continue. Bond funds versus individual bonds. So bond funds is nothing but a wherein a investor pool money. Sorry, the company pools money from investor to buy and invest it in many different bonds. It has a one unit, and in that unit there are different types of bonds. So our money, our investment is going into different types of bonds. Okay, so which is offering a diversification. It is same as mutual funds. How mutual funds work? So the same is for the bond funds. Okay. And you all know about individual bond, direct ownership of a specific bond. I am directly issuing a bond to a person, to a single person. So it is nothing but an individual bond. Okay. Now, how to analyze a bond prospectus? So a bond generally has, So bond terms written in it, issuers detail, risks, financials, and etc. etc. There are many things like maturity. What are the terms, the guidelines, the details, the issuer's details, who the person who is issuing, okay, the risk, the coupon rate, financial, etc. etc. So reading the bond prospectus will help to access the bond quality. We can get to know the quality of a bond, that yes, that it is worth investing in it or it is not. Okay. So for example, we can look for coupon rate, maturity, rating, call provisions, and issuer credit worthiness. Whether the bond is worthy enough to purchase or not. Okay. This is just a basic, you know, how to analyze a bond prospect, how to analyze a bond. It will help you in at a time of purchasing a bond. Okay. Now summary, or we can say key takeaways. So what we have learned so far from the bonds, what are the major key takeaways that we should consider in our mind? Bonds are fixed income, okay, safer but lower returns than stocks. Bonds are the fixed income security. We know the meaning of fixed income security, correct? We know some financial terms like, coupon. What is coupon rate? It is nothing but interest rate. Yield, it is nothing but a return from an investment. Risk risk before investing. The credit agency, what are those? S&P, ICRA. So these are the credit rating agencies. What are the credit rating, or I can say the rating of a bond? Triple A, double B, triple B, D. D stands for default. Triple A is the highest and safest bonds. Okay, so we all have studied that. So we can use bonds for income, for generating a steady and stable income, and diversifying our portfolio to reduce or avoid the risk. Okay, then we studied about the duration, the Macaulay duration. All right, and what all we studied more? Macaulay duration we studied, and then yes, what is sinking fund? Sinking fund is nothing but a fund that is used to retire our bonds early is called as sinking fund. Then how to analyze a bond prospects, the different types of bond, municipal bond, corporate bond, and other etc. I have seen someone has raised his hand. Okay, if you have any doubt, you can ask me. You can unmute yourself. Anyone who have any doubt regarding this today's session can unmute yourself and ask me whether you have not understood any concepts or any terms or any financial terms or anything about the bonds or fixed income securities market. You can ask me. You can type in chat box, or you can raise your hand, or you can directly unmute yourself. Okay, so we have discussed about advantages, disadvantages, how to buy bonds, what are the platforms that from which we can buy our bonds, what are the sovereign bonds, sovereign gold bonds. Okay, so this all we have discussed. Inflation index bond funds, and individual bonds, the difference between coupon rate and yield, and the role of bonds, types of bond issuance, the public issue and the private placement we have discussed. Okay, the risk that comes in the case of bond is credit risk, that the bond issuer will fail to make interest or principal payment. What is credit risk? It is a risk wherein a bond issuer will fail to make interest or principal payment to the bond holder. All right, interest rate risk, Okay, what are bond ratings, importance of bond ratings, the different types of yield, current yield, YTM, yield to maturity, realized YTM, how they are calculated, what are the formulas. We all have discussed about it. And what else we have discussed? Features of bonds, how do they work, some certain terminologies regarding it, types of bonds, callable, convertible, green bonds, zero coupon bonds, municipal bonds, corporate bonds, and also we have studied the importance of diversification. Okay, time value of money. What is time value of money? Risk and return concepts. So I'm just revising you all the things which we have done in our session. What is valuation? We will be studying it in further sections. Our next session will be on mutual funds. It is very interesting. The mutual fund is, a great topic to learn. So next session will be on mutual funds. What are the investment vehicles that drives our money from one place to another? Okay. So this all we have studied in today's session. If you have any doubt, you can ask me. So this 10 minutes I am giving you for the Q&A session. So in case if you have any doubt, you we have 10 minutes and we can discuss anything if you want. Any slide if you didn't understand any concept, any financial key terms, terminology, you can ask me. Okay, so go ahead. Yes, I'm waiting for your questions.